Michael Burry is betting 90% of his portfolio against the market. You don't make such a move unless you're confident that the market will collapse. He's betting $1.6 billion that the market will crash. An insane amount of money, because if he's wrong, he will end up losing his entire fortune. Michael Burry isn't someone who makes random predictions. He has a good track record. He firmly believed that the housing market would crash back in 2008, and he put his money where his mouth was, even though people made fun of him back then. Betting his entire portfolio against the largest market in the country was foolish, but he ended up being on the right side of the history, making hundreds of millions of dollars in the process. In 2020, when the Fed lowered the rates, he made two predictions that ended up being entirely accurate. One, he firmly said that this would create massive inflation that could get out of control, and that the market will crash in 2022, which we all have seen has happened. The crash was so bad that some huge companies filed for bankruptcy. We're not talking about some random companies that nobody heard about, but rather some of the most popular players in the market. So let's find out why Michael Burry yet again betting against the market, and why is he confident that he put $1.6 billion on the line. Michael Burry bought $866 million in put options against a fund that tracks the S&P 500 and $739 million in put options against a fund that tracks the Nasdaq 100. To understand Michael Burry's prediction, we have to understand what put options are. Options might seem complicated at first glance, but they're very simple tools that professional investors often use to make a profit by predicting the market. A put option is a contract that gives the buyer the right to sell a certain asset at a predetermined price within a specific time frame. Let's say I firmly believe that the price of Apple stocks will fall in the next 3 months by 40%. I can buy the right to sell, let's say 10 Apple stocks at $200 each. 2 months from now, if Apple stocks falls to $122, I can buy 10 Apple stocks for $120 and sell them for $200, because this contract gives me the right to do so. On the other hand, if the price doesn't fall but rather rises instead, I'm not obligated to buy and sell the stock at that price. It's a right, but not an obligation. It's a risk, but if things go south, I don't have to conduct the deal. The only money that I will lose is the cost of buying that contract. It's a popular strategy among professional investors, especially on Wall Street. But let's go back to Michael Burry's bet. He put almost $1.6 billion against the S&P 500 and the Nasdaq. Since the S&P 500 represents the entire US economy, he's betting against the entire stock market. The fact that he separately bet half of that money against the Nasdaq alone makes it even more interesting. Because Nasdaq is mostly focused on tech stocks. Every major tech stock you see, from Amazon to Apple to Nvidia, is traded on Nasdaq. And since we're living in the age of technology, tech stocks make up the majority of the stock market. Here is the list of the top 10 S&P 500 companies. What is common among all of these companies is that they're all tech stocks, except for the last two, which are United Health Group and Berkshire Hathaway, an investment firm belonging to Warren Buffett. If you look at Berkshire Hathaway's portfolio, you will notice that 40% of his entire value is from investments in Apple, which is a tech company. Take that out, and Berkshire Hathaway is no longer in the top 10 largest companies. And that tells us a lot about Michael Burry's bet. Assuming that he's right, the entire stock market is just one giant bubble that is likely to collapse, tech stocks make up almost 30% of the entire S&P 500, and the collapse of tech stocks will at least crush the market by 10%, which will lead to a domino effect and crush the market overall by far more than 10%. To put that into perspective, in March 2020, when the pandemic hit the world, the stock market witnessed one of the biggest crashes in its history when it collapsed by over 30%. So a 15% crash is at least half of the largest crash in history. But unlike 2020, the crash at this time is going to be very different. You see, if you go back to the pre-pandemic level, you will realize that the Fed kept raising the rates to a substantial level. So when the market crashed in 2020, the Fed had the option to lowering the rates to zero. However, with the inflation we have today, that option is no longer on the table. So according to Michael Burry, we might witness a crash that could be as bad as 2020, but without the option of relying on the Fed to save the market. While that sounds scary, the country has been through such a crisis in the past. It is not something we haven't seen before. Every time we go through such a crisis, it's either the rich get richer or wealth changes hands from the old rich to the new rich. That's why often during crises, we have new billionaires. The 2020 pandemic is the best illustration of that. It's difficult to understand how big of a crash it would be, but in May last year, he has tweeted that he expects the S&P 500 to fall to 1900 points. To put that into perspective, the S&P 500 now is at 4300 points. That would be an over 50% decline, which is way worse than the 2020 crash. The basis of the stock market is, as companies grow, hire more people, build more products, serve more customers, they will make more money and become more valuable. And the job of investors is to find those companies that operate as effectively as possible, since the basic principle is all assets sooner or later will bounce back to their true value. But 2020 has fundamentally changed that perspective. People stopped working, factories closed down, and companies stopped growing. But somehow the stock market kept growing. In fact, it grew by over 18%. A good argument is that although people were required to stay at home, they still received stimulus checks and many still kept working regardless of the pandemic. But that wouldn't have in any way created a strong enough demand. Besides, most US companies depend on Chinese factories, where the government implemented a zero-COVID policy. Supply chains were disrupted, demand barely grew, and companies were in chaos. All that mattered is survival. That's what should have happened in a real capitalistic world. But that also meant a disaster that could have ended badly. So the government opted for a more relaxed option. Yes, I am talking about printing money. The stimulus checks were nothing but just government's attempt to print and distribute cash. Although it was one of the main factors that led asset prices to dramatically rise, it wasn't the main factor. What saved the thousands of companies that should have gone bankrupt during the pandemic was the zero rates policy. That explains why the market grew by over 18% in 2020 and 28% in 2021. Unlike the stimulus checks, the government didn't distribute cash to companies for free. The government just relaxed regulations to make it easier for corporations to access capital. But zero rates meant that companies could borrow money at a very low rate. As long as the rates were below inflation rate, it's basically free money. It didn't really matter whether it was a huge company with dozens of billions of dollars in cash or a small company that barely survived. No one could just sit aside and not take advantage out of this opportunity. In normal times, companies work hard trying to build products that would compete in the market, try their best to satisfy their clients, and as more people purchased their products, more money would have come to the company, which made the company more valuable. But now, all that suddenly became irrelevant. In order to show strong financial statements, companies just had to borrow as much money as possible. It didn't really matter whether they needed that money or not. More cash coming in at a super low rate makes the company more profitable, which attracts more investors. That's a perfect recipe to keep the economic wheel turning when there is a pandemic. But that creates two fundamental problems. First, what happens when the cheap money is no longer available? Well, we already know, 2022 wasn't an easy year for the stock market. The S&P 500 fell by over 18%, and many tech stocks collapsed. But the panic is over and the market is growing again. The bad days are over. However, there is still another problem. Increasing the rates does make the cost of capital more expensive, but it doesn't solve the fundamental problem that it had created in the market in the first place. All of that extra cash in the economy has turned the market into a giant bubble. Raising rates does stop the bubble from growing, but the bubble is still there, and with each passing day, the probability of it bursting rises. That's why if you look at Michael Burry's bet, he's primarily betting against tech stocks. Half of his bet is against the Nasdaq 100, which are all tech companies, whose stocks were inflated by cheap cash that the Fed injected into the economy. and the S&P 500 that comprises of almost 40% of tech stocks. He's definitely right about the bubble, but timing the market is not an easy job. So betting $1.6 billion on this is nothing short of a bold move. If you guys have enjoyed this video, make sure to give it a thumbs up. And if you want to see more similar videos, make sure to subscribe. Thanks for watching, and I will see you in the next one.